A big study in the construction industry found that effective contract administration improves profit margins on projects by between 10 to 15%. You probably didn't need a study to tell you that missing variations or getting time barred impacts your profit margin. To me, the real question is, given these stats, given everyone knows that managing contracts better improves profitability of projects, why isn't everybody doing it? And the reason isn't because contract administration is hard or complex. Pouring a 6-meter high in situ concrete wall and the temporary works associated with that is complex. Coordinating and managing construction sites with hundreds of workers is complex. But contracts admin is genuinely pretty easy. It's just reading the contract, setting up systems, and following rules. So in this video, I'm going to give you a complete guide to construction, contract administration, and how to set up systems that improve the profitability of your projects. In this course, we're going to be talking about what is contract administration and why it matters. We'll give you a framework you can use to simplify and apply construction contracts. And then we're going to talk through the different phases of contract administration, talking about project setup to then business as usual or regular ongoing contract administration tasks. And finally, how to deal with change, variations, change orders when they come up. For each of these processes, we'll talk about what systems, tools, registers, templates you should be using. Then all the different documents and templates I'm using, I'll put in a toolkit you can download free in the video description. So first up, I want to start very simple and very high level and try to answer the question, what is contract administration and why does it matter? Now, if you've already got some experience in contracts, you can probably skip this because it's going to be very fundamental. But basically, a contract is an agreement. One party agrees to do something, some sort of work. We refer to them as the contractor, and the other party agrees to pay them for it. So for example, you have a project owner who wants to build a road, and you have a contractor that says they'll do it for $2 million. They agree to this. They sign a contract saying that one party will build it, the other party is going to pay them for it. And the contract defines what's going to be built, how long it's going to take, how much it's going to cost, and what happens when things changes. Basically, the contract details the specific terms and conditions around this agreement. Contracts exist for the fundamental reason that projects are complicated and they're too complicated for one company to do by themselves. If you think about what's involved in building a simple road, we've got structures, earthworks, utility relocations, design, architects involved, managing community relationships. Basically, the amount of work involved, the amount of specialist skills needed, it's going to be too complex for any one single company to do by themselves. For that simple reason, there needs to be a framework around which companies can collaborate. So to deliver this complex piece of infrastructure, we've always got a situation where one company is engaging another company to do work on their behalf. They could do this without a contract, but there would always be a risk that the company that's paying for the work refused to pay. You could have a situation where something happened with the contractor, they underquoted the job, and then decided they couldn't do it for the price. Without a contract, both parties would want guarantees before they did the work. If you're the contractor building it, you want to get paid before you started spending money. But if you're the person developing it, you're paying for somebody to build it. You only want to pay them after they've done the work because then you can be sure you're getting what you paid for. So without some way of formalizing the agreement and without some way of being sure that the other party was going to do what they said they would, it makes collaboration almost impossible, which is where contracts enter. Contracts make collaboration possible by putting expectations in writing, creating clarity, and reducing uncertainty. The contract isn't just a piece of paper that says what one party will do or another party says they'll do. It's fundamentally enforceable by the courts. So if one party doesn't say what they're going to do, it's in the contract, the courts will enforce these agreements. Party A can sue Party B if they don't do what they said they were going to do. If a contractor walks away from the job, the client could sue them to recover costs. If a client refuses to pay, the client can recover payment through the courts. Because of this, because both parties know that the courts are going to enforce these decisions, it makes it more likely that they will stick to the agreement. And fundamentally, because the courts will enforce contracts, parties are much more likely to follow through and do what they said. And this isn't just specific to construction. Contracts are the building block of any sort of collaboration between two companies across industries. Okay, so now I want to dive a little bit deeper into contracts in construction. So contracts fundamentally specify and detail an agreement But when we're talking specifically about construction, they follow this repeatable pattern. Every construction contract will have what's referred to as a principal or owner, and a contractor, someone that's doing the work. The project owner is paying the contractor to do something. The contractor is doing something and getting paid for it. Now, this isn't just between the project owner and head contractor. The head contractor and their subcontractors will have an agreement. The head contractor may engage an architect to do design services. They may engage subcontractors to do specialty trades. So that's why you have these hierarchy of contracts on a project. A subcontractor could even engage other subcontractors to do work. So on a construction project, the project owner will subcontract to a general contractor. That in turn, the general contractor will engage their own subcontractors, creating this hierarchy of contracts. The upstream contract I referred to as the head contract. So that for the head contractor, that would be a contract with the owner. The downstream contracts I refer to as subcontracts. So fundamentally, contract administration, it's just about reading and understanding the contract, doing what we said we would, and getting what the contract says we're entitled to. Now I want to talk about understanding the contents and structure of a construction contract. Basically, a 70-page document with all these attachments. I want to give you a framework for how you make sense and understand it. I want to give you a framework so you can understand what you're responsible for, what you're entitled to, and how these rules govern the relationship. So the first thing to understand about a contract is it's never one single document, it's a set of documents. The front document or the head document is referred to as the general conditions of contract, which is typically what we think of when we think of as a contract. But that document is just a set of clauses. It'll be broken down into clauses about time, payment, security, whatever. It's all the contractual mumbo jumbo. Attached to that are the drawings, specifications, the scope of works that define what we're actually building. So the general conditions of contract are the head document, and attached to those are the specific documents that define the actual work. All these documents together encapsulate the overall agreement, the agreement of what we're agreeing to do and what we're going to get paid for it. Now, as I'm going to talk about in a second, these documents have to be read in a certain hierarchy, because when you're talking about a 100-page construction contract with all the attachments, there will be conflicting information. So as I'm going to talk about later, you have to understand the structure, but you have to also understand that there's a hierarchy associated with it. So we can basically break down a contract into 3 core chunks. We've got the general conditions, which is the form of contract. So it might be a fitted contract. It could be AS 4100 in Australia. They are the standard terms and conditions, the core risk allocation. Is it a design and construct contract? Is it construct only? Is it schedule of rates? Is it labor hire? Is it plant hire? That contract will define all the key terms and conditions and the contract processes and procedures. Now, at the end of that contract or somewhere in there, there will be the special or particular conditions. This is the project-specific amendments to the general conditions of contract. These are things like the liquidated damages rate, the project start and finish date, the key contacts, key people, a brief description of the project. These will enhance the general conditions. So the general conditions will define liquidated damages applies if you overrun your practical completion date. The special or particular conditions will say what the practical completion date is and what the liquidated damages amount is. Then after that, we've got the supporting documents. These are the guts of the technical agreement and define what we're actually building. This will be the scope of works, the drawings, the specifications, the schedules, and the program. Now, this structure is important to understand because when you look at an actual construction contract, it often will barely say anything about what you're actually building. It's just a bunch of legal terms and conditions. The supporting documents is where the actual construction works is defined. However, you will almost certainly have overlaps, gaps, errors, and contradictions in this information. More so when you have a scope of works, design drawings. The drawings might say one thing, the scope of work says the other. It's important to understand the structure because it'll help you read and understand the contract. You also understand what documents form part of the contract, because clients love to send additional information after the fact. But understanding you have the contract and you have the attachments. If it's not a contract attachment, it doesn't form part of the agreement. But you also understand the hierarchy of the agreement. You have an order of precedence in the contract, which says in what order are these documents to be interpreted. For example, you have a particular condition in the contract that has the practical completion date. but then you're given a program that has a different completion date. It will typically be an order of precedence in the contract that says that particular conditions of the contract form a higher order of precedence in the program, in which case what the contract conditions say would be more important than the program. Within the supporting documents, you also have an order of precedence. If you have a scope of works that has a bill of quantity item in it that is 500, but then there's a drawing, you count it, and it says that quantity is 1,000, what the scope of work says will typically take precedence over the supporting documents. So understanding all these documents, what forms part of the contract, and what order they need to be interpreted in is essential to understanding what you're actually obliged to do, but most importantly, not to do. Now, I ran into this exact problem on an oil and gas project where the client had given us a bill of quantities saying something like we had to do, 100 lights, but then the drawings showed 200 lights. Because there was an order of precedence in the contract and it said the scope of works and bill of quantities took precedence over the drawings, we got a variation for that because it was clear in the contract that the scope of work said one thing. The scope of works was the more important document, but the client had made an error when drafting the scope of works. They used the wrong quantity. So therefore, the contract was adjusted to the new quantity. So fundamentally, you need to understand what documents form part of the contract and what order they need to be read in. Now, I probably ranted way longer than I had to on that point. It's not a super it's not a super difficult concept to understand, but it is unbelievably important because all these projects are so messy and chaotic. There's so many conflicting bits of information. You just need to understand what the contract documents are and what order they need to be read in. Now, when we're talking specifically about the general conditions of contracts, so that 70-page document full of terms and conditions, the simplest way to think about what every clause says is that every clause is either going to be an obligation, something you have to do, or an entitlement. For example, practical completion date, that is an obligation to complete the works by X date. The contract will have an entitlement that we can claim payment monthly, or if the works are changed, we can issue a variation. And contract administration, we can think about in that same framework. It's about doing what we said we were going to do, our obligations, but also enforcing our entitlements, making sure we get what we said we would. A lot of construction contracts have in them the role of the superintendent or the contract administrators. This is often referred to as a decision maker role. If you're a general contractor subcontracting works, this role won't exist, but project owners delivering large projects will often engage a third party to manage the project on their behalf, referred to as the superintendent or the contract administrator, who isn't actually a party to the contract. So they're not the ones paying for the work to be doing, and they're not the ones doing the work, but they're the ones who are almost acting like an umpire that's issuing directions, assessing variations in EOTs, and certifying payments. But again, most smaller construction contracts or where you have a general contractor engaging subcontractors, this role won't exist. So next I want to go on and I want to start unpacking all the core elements of a construction contract, and the most important one, which isn't one of the clauses in the contract, it is the scope. What are you actually agreeing to deliver? And as we all know, the scope is the messiest and most complicated part, because fundamentally construction projects are confusing, they're technically complicated. So then capturing this in a document that perfectly describes what you want a contractor to do or what you're being engaged to do is fundamentally challenging. So the scope is going to be the source of most disputes and issues on the project, but it's also the most important section of the contract. It is the substance of the work, what the contractor is agreeing to build. So how is scope defined in the contract? Well, it's defined through the attachments to the conditions of contract. We've got the scope of works document, the drawings, any specifications like a concrete material specification or an electrical cable specification, schedules or bills of quantities, and management plans for how you have to deliver the project. These documents define what is included, what is excluded from the scope, also what could be implied from these documents, and what interfaces exist with other contractors. Disputes in projects are always technical. They're never about some random clause or its interpretation. Well, they become about that, but they always originate from technical issues. Things like whether the testing was in your scope or not, or whether your material supplier should have included delivery in their quote. I don't care how small the issues are. Fundamentally, what we're paying someone to do is where all our disputes are going to be. So understanding how scope is defined, what documents it's defined, and also, again, coming back to this issue, the order of precedence for interpreting these documents is absolutely essential. As an extension to this idea of scope or the physical works you're contracted or contracting to do, is this idea of risk and uncertainty. They're separate, but they're also very interlinked. You've got the physical product you're creating, the work you're doing, the work you're being contracted to do. Then you've got to also understand the uncertainty around that and what uncertainty you're responsible for. For example, if it rains, do you get paid extra? If it rains for the entire duration of the project, can you adjust the practical completion date, or are you going to be up for liquidated damages? If it rains and you have to do rework, do you recover the costs for that? All these factors need to be considered because there's so many unknowns within a construction project. We don't know how much it's going to rain. We don't know the actual productivity rates of the people doing the work. We don't know if there's going to be huge materials supply delays. Contracts are as much about a scope transfer exercise or specifying what we want to build, but also specifying what risks and obligations the other party is going to be accountable for. These are going to be things like issues in the design, weather, material supply, whether there's another pandemic, who's going to incur the cost of the delay to the project for that. So after understanding how scope is defined, you need to understand how uncertainty is defined in the contract. While scope is going to be more about the technical documents, risk and uncertainty, there's going to be more clauses in the contract specifying responsibility and obligations about certain different events. The next set of clauses that are important to understand is what guarantees we're making about the product we're building or creating. So depending on the type of project you're doing, and again, what the contract says, some contracts will be purely construct only. You're given a set of drawings, you're building to the plans, in which case, as a contractor, your fundamental obligation will be to build what the drawing is set. Contracts can extend these obligations to the contractor. You might have a fit for purpose clause where you're actually responsible for achieving the design objectives. For example, if you're building a solar farm, you have to guarantee that it'll produce 100 megawatts output. So this is where you start to have warranties or guarantees around the performance of the product you're building, which is obviously an important source of risk in a project. The next set of clauses you want to understand are any obligations around time. Fundamentally, time is money in construction. You've obviously heard it, it's a cliche, but it's important to understand why this is. You're talking about this from the perspective of the contractor. The duration it takes to deliver the project is the duration you need to pay staff salaries, hire office buildings, pay a security guard to come by at night. All those costs are driven by the duration of the project. So if the project takes longer to build, it'll cost you more to build. You'll also have delay costs associated with building something. If it takes you longer and you overshoot your practical completion date, you'll incur liquidated damages. From the perspective of the project owner, say they're building a solar farm, the earlier they get this solar farm built, the earlier they can start exporting electricity and selling that electricity, so generating revenue. So it's important to understand that time equals money, and that's why there's going to be a lot of clauses and obligations around time. So when we're talking about time, the key concepts you need to understand are the actual dates in the contract. So this would be the contract award date and the practical completion date, the date you need to finish the work. There's both a date of contract award and a date for contract award. There's a date of practical completion and there's a date for practical completion. Sounds semantic, but really what it just means is your date of practical completion is what's written in the contract. The date for practical completion is the date you actually finish the work. You might have a single completion date, or you might have multiple completion dates for different packages of work. For example, you're doing a concrete subcontract, you might have 2 or 3 separable portions. So these are different packages of the works. Against each package of work, you have a date you need to finish that section of the work, and associated with that date, you'll have a liquidated damages rate. Liquidated damages are a daily rate or a daily cost the contractor is billed if they are late in finishing the work. So say, for example, you're 10 days late in finishing a project and your liquidated damages penalty is $2,000 a day, you would have to pay an extra $20,000. Or you'd have $20,000 taken off your next payment claim because you were late in finishing the work. The liquidated damages is the primary mechanism through which the principal can motivate the contractor to finish the work. So if we look at this simple diagram here, the difference between the date of practical completion when you actually finish the work, and the date for practical completion is the duration of the liquidated damages. There are going to be issues that come up during the execution of the work where the scope changes, you're doing extra work, the client was late in giving you access to site. You can adjust your date for practical completion in the contract. That is through a process called an extension of time, where you can prove the client has been late in giving you site, that's impacted the duration it's going to take you to do the work. You can get an extension of time where you adjust the completion date of the project. The way you justify any sort of change to the practical completion date is through a construction program. Construction program, we think of it as a scheduling tool, but it is fundamentally one of the most important contract management tools. That's because it's the principal's way of checking that the contractor is on progress before they overshoot their practical completion date. So most construction contracts will say in them that the contractor has to maintain a construction program and issue it weekly or monthly, whatever the contract says. And it is the contractor's way of demonstrating to the principal, if they've been delayed, that they can claim an extension of time. And that is done through a concept called the critical path. The critical path is the sequence of activities that, if delayed, delay project completion. So if you have a schedule like this, you have this mobilize the site date. Before the mobilize the site date, the client needs to give you access to site. If you can prove, you can just see from the schedule that if this mobilize the site date pushes back all these activity dates, pushes back the completion date, you can show that your critical path activity of mobilizing the site has been impacted by a client-caused delay, so you can justify an extension of time. So the contract program is an essential tool for both the client and the contractor to manage the scope of works. So when we talk about a contract program, there's a couple of terms you need to understand. The first is the as-planned program. This is the program that goes into the contract that you sign and agree to. Then you've got the as-built program. This is where you update actual progress on the schedule, show when things are actually happening. You've got critical path activities that impact the finish date of the project, and you've got non-critical path activities. When an activity on the critical path is impacted, you can claim a delay to your project, which allows you to claim an extension of time. I'll talk about extension of times in a second. And you've also got disruption claims. So if a client impacts a non-critical path activity, for example, this activity where the finish date could shift and it's not going to shift the next activity, you can claim a disruption. So you can't claim a change to the finish date, but you could say it's going to cost me more because I can't do it in the most efficient way anymore. Now, because time is essential to any contract, if you want to get good at contract management, you need to understand scheduling. So far, we've spoken about the scope, what we're building, the risk, what uncertainty we're also responsible for transferring to another party. Then we've spoken about what guarantees are being made about that. Then we've also spoken about how long we have to build it. The next logical thing to talk about is how do you get paid for or pay for someone to build it? Payment is probably the most contentious issue on construction projects because payment impacts cash flow, and cash flow is the number one source of insolvency within the construction industry. Paying the contractor for the work they're doing is the primary obligation of the principal, and it is also a very powerful negotiation tactic. And that's why there's so many laws and regulations around payment, because historically, principals refusing to pay contractors has led to a lot of contractors going broke, even on profitable projects. So the contract is going to define in detail how the contractor is going to get paid for the work being done. Is it on lump sum? Is it a schedule of rates? Or is it completely cost reimbursable? So that's probably more of a question of risk and who's responsible for what, but that's referred to as the payment mechanism. It's also going to specify when you can make payment claims. So typically they'll be monthly, and it will specify a date by which the contractor will have to make their monthly claim. It's also going to specify what should be included in the payment claim as substantiation. So photos, QA records, signed day sheets, all these things will be specified in the contract, and also how long the principal has to respond to any payment claim. I want to talk about this more in a later section when we talk about the regular business as usual ongoing regular tasks, but basically the way payment works on a construction contract is you'll have the contractor every month will submit a payment claim which says, here's the contract sum items. We've done 50% of the earthworks, 20% of the electrical works, 10% of the building. They'll put a percentage against that line item. The client or the if you have a superintendent on the project, will assess that claim against the work they've completed, but any breach of contract by the contractor. For example, if they're incurring liquidated damages, they'll set that off against the work, or if they've got variations that have been approved, they'll also look at that. The two parties then agree on a payment claim. They might go back and forward a little bit, but fundamentally they should agree. And a progress certificate is issued to the contractor, which says you can claim $200,000, $250,000, whatever it is. Then the contractor will invoice for that. That'll happen monthly through the execution of the project up until the last month of the project, where they'll submit a payment claim and give the practical completion certificate. The defects liability will complete, and typically at the end of the defects liability period, the contractor can make one additional claim. So I've probably said this 10 times during this presentation, but it is difficult to define scope properly on construction projects. They're messy, complicated, confusing. That is why also construction is highly uncertain. We don't know things like how much it's going to rain, what the ground conditions are. We're going to come across asbestos. All these things make change an inevitability in construction. So contracts always have defined processes for how you deal with change, referred to as variations, or if you're in the US, a change order. Now, there's two main types of variations. There's proposed variations. This is where the client sends a request to the contractor to change the scope. For example, they want to install, an additional elevator in the building. The other type of variation is a claimed variation. This is where the client doesn't automatically agree to the change in scope. They're claiming for a variation after the fact. So they've said, you delayed us coming to site. We want to submit an extension of time claim. Now, the claimed variation is slightly more complicated because they're not automatically agreeing to the change in scope. With a proposed variation, because the client is issuing the variation request to the contractor, they automatically assume it is a change of scope. So the only thing they can disagree on is the price of doing the work. I'm not sure if you've seen this photo that's gone around for years, but it's the one everyone references when they talk about variations. Because construction is so highly commoditized, people win work based on being the lowest price. Contractors are often ruthless with submitting variations and putting huge margins on those. So that's why there's this cliche in the construction industry that everyone makes money from variations. And fundamentally, why if you're going to effectively administer a contract, you need to understand how to manage variations. Now, related to this idea of variations are notices and time bars. Any contract in it will have set periods of time where contractors can claim for variation. Say, for example, you become aware that the client has delayed issuing access to site. Contract will specify a fixed time period within which you can submit a claim for that. If you don't submit a claim within that period of time, you get what's referred to as time barred. This makes sense because if you've been delayed getting access to site, the client wants the ability to mitigate that delay. So if you tell them, oh, yep, this is going to cause us to change our completion date and it's going to cause us to spend an extra $5,000 a day in overheads, the client should be notified of that quickly, which is why you have the time bar in the contract, so that they can actually do something to mitigate the delay. Also prevents situations like at the end of the project, the contractor trying to put in a whole lot of variations well after the fact. So the contract is going to specify within which time frame you can submit notices, the correct format, and the correct person to send them to. The next concept to understand is a latent condition. A latent condition is a physical condition of the site that's not reasonably foreseeable. The contract defines what qualifies as a latent condition. For example, if you're doing earthworks and come across poor ground conditions, is that something you are responsible for taking the risk for, or is that going to be a variation? So the contract is going to define the latent conditions and what you can reasonably claim a variation for. Contracts also have clauses in them about quality and defects. Typically implied within the construction works is this sort of relates back to when we're talking about warranties and fitness for purpose, that when you're building something, the drawings define what you're building. The contractor almost always has an obligation to be able to prove that what they built matches the requirements in the drawings. The contractor is almost always responsible for the quality assurance and testing works. The contract is going to define in it what happens when the contractor isn't doing the works to the correct extent. For example, say they have a defect within the works. What's the process that the principal has to work through to tell them to come back and rectify it. If they don't rectify it within a certain period of time, what options does the principal have? It's also going to specify after the completion of the work, how long the defects liability period is, how long the contractor has to come back and rectify defects, and what happens if there are defects after this period. At the tail end of a project, particularly when you're managing multiple subcontractors, coordinating and managing their closeout and their defects, how this relates to giving them practical completion, what to do if they're not coming back and fixing defects, will be an important part of administrating a contract. Now, this is an important concept to understand as well when it relates to security. So, security is basically a sum of money the principal holds that the contractor gives them at the start of the project. So, for whatever reason, the contractor walks away from the job, maybe the contractor goes broke, they have a sum of money they can use to basically engage another contractor to come and finish the work. Typically, this will be like 5% of the contract value. I've seen it go up to 10%, and it can take different formats. You can have a bank guarantee, which is a letter of credit from the bank that for whatever reason, if the contractor fails to do their work, the principal can take that and basically take that sum of money out of the contractor's bank account, or it can be retention, where they hold a percentage of each monthly payment claim back. On top of this, the contract is also going to specify different insurances the contractor holds. These might be things like public liability insurance, workers' compensation insurance, professional indemnity insurance. These is basically for any sort of issues that might come up if the contractor go broke. By holding the insurance policies, the principal is still going to be covered. Now, in the unfortunate event that the relationship between the two goes sour, the contract is also going to define what the process for resolving disputes. Is it going to be negotiation, expert determination, arbitration, how notices are issued, what to do if you think another party hasn't been following the contract? All this stuff is captured in the default and dispute section of the contract. Okay, let's move on to talking about contract admin during the setup phase of the project. Now, first I want to start by talking about a concept that you're probably all familiar with. It makes sense intuitively, but it's really fundamental to understand. And basically, it tells you when to put in the most time and effort. And basically, the concept is at the start of a project, earlier on in the project life cycle, you have a significantly greater ability to influence the outcomes of the project for the same amount of effort. As you proceed through the project, the cost of changing things significantly increases. So any effort you spend at the start of the project setting up things correctly is going to be drastically better than time spent at the end of the project. You just don't have the same ability to influence outcomes. So once we've signed a contract, the budget is set, the completion date is fixed, and the terms and conditions are locked in. So when we're talking about setup, it's what we do from this point in time. We can't negotiate terms anymore. We can't change our budget. All that stuff is set. What we're trying to do is set up our contract administration process so we do the work we agreed to with nothing extra, and we protect our time, cash flow, and entitlements. So fundamentally, this is all about setting up the project correctly. Now, there's two systems I want to talk about when setting up a project. There's your contract administration, which is what we're going to be talking about, and then there's just general construction management, which is just doing the work safely, correctly, and efficiently. So this is things like creating a work breakdown structure, scheduling out the work correctly, doing your procurement, signing up the right subcontractors who can do the work, and basically delivering the project effectively. Now, you can't effectively administer a project that's managed badly. You just can't. The construction management tasks we do to set up the project are always going to be much more important than the contract admin task. You need to deliver a project effectively before you try to worry about administrating a contract. So really, contracts admin is always going to be a reflection or an amplifier of how well we're delivering the work. I guess the core concept here is you can't admin a bad project. Now, I want to mention another point that I've already spoken about, that for some reason in the construction industry, the better people seem to be at contracts, the worse they seem to be at construction. The better people seem at construction, the worse they seem at contracts. We want to set up our project, our systems in this box, the quadrant, the ideal box, where we're managing the contract well and we're managing the construction. So success in contract administration, on top of needing to deliver the project correctly, requires disciplined process and templates and registers. So I'm going to talk about in this section how to set all these up. The goal is simple, that we want to, in this stage, set up the systems so the contract administers itself, and we're not relying on memory, remembering to do things, or heroic effort. We want really simple systems and registers that we maintain, keep updated. We're documenting and recording all our communication. We've got systems. When a variation comes up, we know exactly what to do. So the fundamental concept behind this is we want to take the contract, which remember is our rules for how we manage a project, and we want to turn it into a series of workflows. A client request for a variation comes in. We have an exact process of what we do. We notify the client. We've already pre-built a template that we populate to do this. We know we've got 10 days to prepare a price. We've got a library of rates and a construction variation register template. And basically, we have all our templates set up and we have an exact process we follow, because really, a contract is really probably going to be between 10 to 15 different processes and templates that we're just using on repeat. So step number one in our project setup phase is we want to create a contract summary. Contract will be a 70-page document, largely full of circular definitions that probably don't matter that much. We want to turn that into a 2-page summary of the essential clauses and the specific information related to that. For example, what is our notice period for variations? What's the liquidated damages rate? What are the different separable portions? The essential information that's specific to the contract. We don't want to put in there definitions because everyone knows what liquidated damages means, or everyone knows what a time bar is. More about putting that essential information in there that's specific to the project. So on your contract cheat sheet, 2-page document that people can refer to, you want your key dates, your payment claim dates and response times for payment claims, what information you have to put in to substantiate a claim, the variation process and any approvals, EOT, delay notice requirements and time bars, security, insurances and any warranties, any key roles, the order of precedence, and maybe the liquidated damages rates. It's really just the essential information to save people having to go back and refer to the contract so they can quickly access it. Step 2 is going to be setting up your project filing and communication, because effective contract administration relies on good documents and records. The first thing I would do is to set up your project folder structure, where you have clear folders for things like procurement, contracts, and commercial. You have a head contract folder, folders for all your subcontracts, scope of works, any sort of qualifications or variations you've submitted, and you want variations associated with all these documents. For example, you want a variation register, you want an RFI register, you want to track what date things were submitted and what dates they were closed out. Also want, and I think this is best practice, you want a project email address, which you copy in for all your important communication. Now, you can set this up with a simple automation that just logs all your communication into an Airtable database or a Microsoft Excel database. But every important communication, you copy in your project email address, it stores it in a database like this. So that's why when you're looking for communication about a scope clarification from tender or something about a variation that you're trying to close out, you can just simply search that database to find it, because we all know Gmail and Outlook search is absolutely terrible. So really, you're setting up a folder structure where all your information is getting stored that makes sense to you. This is a structure that makes sense to me. And you're setting up a project email address. Some projects you'll have tools like TeamBinder or Aconex where you formally capture all correspondence, and that's good. I find often the challenge is people don't document everything in those systems. So a lot of important correspondence still remains in people's email addresses. So that's why I think every project should have a project email address. It should be copied into all important communication, and it just gets logged in a database like this that you can come back to later. The next step is to set up your registers. So registers are kind of like control panels. They're high-level summaries of a specific type of activity, and they basically tell you what there is, what's outstanding, and what needs action. For example, you'll have an RFI register where all your queries to the client have gone into. You'll be able to see the responses, which ones are closed out, what date they were submitted, if any have run over. Or you could have variation register, which tracks all your variations. So basically, for any of these tasks, you want to capture them in a register. Now, here's the registers I think every project should have. Number one is the correspondence register, which could simply be an email address that auto logs into a database like this. So you probably don't need a separate correspondence register if you've set up something like this. The next one is an RFI register. So these are any formal queries you've made to your client, and contracts will almost always specify a time frame within which the client has to respond. It might be something like 10 business days. You want a variation register, which documents both the proposed and claimed variations to the client and the status. You could have this within the variation register, or you could do it separately, but you want to delay an EOT register, which captures changes to the practical completion date. You want an instructions or directions register. So this is where the client has made site instructions. You probably wouldn't capture these as a variation. You might capture them as day works, but you still want a register of all these instructions, the email correspondence that's associated with it, and the description of the scope and the hours and any signed day sheets. You want a payment register, so all your monthly payment claims, certifications, invoice dates, and the paid dates. You want, again, this is getting more into construction management rather than simply contract administration, but you want a simple project work breakdown structure, the tasks and the schedule, the quantity of work, the percent complete. That information is obviously invaluable in terms of managing the construction works, but it's also essential in terms of administrating a contract. So that's, I guess, getting into more of the construction management side of things. But basically being able to measure progress against the contract line items, the schedule, and be able to clearly show that to your client is essential. And you also want a quality register. Again, this is more construction management. Quality is also important because the contract will have in it that you have to get your inspection and test plans approved by the client. You want a register of all your inspection and test plans, your agreed quality management plan, that the client signed off on them. You also want to capture the actual inspections, the test results, and any NCRs and defects. Again, so you can show to your client that you are tracking this stuff, you're showing it to them. Then as well, it's really important to have in the quality register is signed walkthroughs so you can prove handing over items to your client. Another really essential one, again, it blurs the line with construction, but some sort of completions or deliverables register. So in the contract, it'll specify all these documents you have to provide to your client, such as completed inspection and test plans, but also signed off management plans, program submissions, all these things. I would be tracking every deliverable you have to provide, not the construction deliverables, but the documentation deliverables. So when it comes to closing out the project, it'll be much, much easier. Again, you want to track and compare that to the correspondence, and also a risk register. So basically any key risks and opportunities, which just is going to help with more planning and administrating the contract. These registers are just fundamentally how you're going to show your client that you've done the work, but also prove variations and other disputes later on, and to get payment claims approved. So documenting everything is absolutely essential. These are the minimum registers you should have in every project. So your registers are your dashboard. They're how you track things. Templates are formats you can quickly fill out to prepare notices, variations, payment claims, meeting minutes, these sorts of things. So templates are essential because they help you produce consistent, high quality outputs. You're not starting things from scratch. So it's making things easier, but also more reliable. Good templates make things faster to do and better. So as a minimum, you should set up these templates at the start of a project. You want your variation notice or claim template. You want your delay notice template. You want a latent conditions notice if it's relevant to your scope. You want direction or site instruction day sheet that the supervisor can sign off, and a dispute notice, but you probably don't need a template for that. You want also a weekly meeting minutes agenda and a way of documenting this, and an actions register. Whether you capture that in an RFI register where you want certain actions closed out by your client, or a correspondence register, you could do that separately. But having some sort of action register where you're tracking information, what you're relying on from your client, is absolutely essential, again, to proving and justifying variations later on. You want your payment claim template, so both the actual format of the claim with the contract sum items in it, but also how you're structuring your claim to provide the minimum documentation requested. So if your contract says you need to submit completed inspection test plans, there should be a format for how you submit the claim and how you're providing those, whether you're providing a progress markup, how you're doing it. These templates, importantly, anything which requires you to submit stuff to your client, you should agree on the format of the template. So getting agreement on the progress claim template before you start the work is going to make sure that there's no delays to that first payment. Basically, the purpose of templates, it just reduces what you have to actually do during construction when things get chaotic. You just basically take the relevant template and fill out the blanks. Everything's quicker. It increases the consistency, and it basically ensures you're going to be compliant. Okay, so doing a stock take of where we're up to so far. We've set up our project filing and communication. We're tracking and documenting everything. We've set up our registers so we know the key bits of information we need to be recording, And we have templates for everything from variation notices to payment claims to weekly minutes. Now, a lot of contract admin, as I've already said, isn't these crazy situations. It's just boring, regular, ongoing tasks. The next thing we need to do is we need to set up a project calendar. This is basically just going to be a weekly meeting with our client and key subcontractors where we're going to go through our weekly meeting minutes. We're going to update all of our registers. We're going to also review all of our registers every week. So once a week, we raise an RFI to the client that goes into our RFI register. And once a week, we follow up with the client. We check on the status of it. We also have a monthly payment claim that's due. So maybe a week before that, we set a reminder in our calendar to get all the information together, to chase up anything that's missing, to do an internal review, and then have a final submission date. And then maybe once a month or when we get new documentation, we do a sanity check that the documents in our folders are up to date and relevant and nothing's changed. Now, step number 6 is, again, this is sort of part of establishing the payment claim and progress tracking templates, but this I think is an essential step to do in the setup of the project. You want to link progress with payment. What I mean by this is you want to set up a universal way to track how you're progressing in the project and agree on this with your client. It's going to make getting payment claims approved so much easier. It's going to make reporting progress to your client so much easier. It's going to make your client happier, make sure you get paid faster, and it's also going to help with getting variations approved. So this I would refer to as the monthly report, but basically you want to decide and agree on with your client how you're going to measure progress. Generally, you'll have the contract sum, which is broken down into a bill of quantities. Against each of these, you should track the quantity complete, quantity remaining, and the total time remaining on the task, and present that to your client. And that's going to capture maintaining your schedule. And it's also going to help you justify getting payment claims approved. You should also agree on what evidence is required to support this. Now, when I've been talking about setup, I've largely been talking about head contract setup, but really the same logic is going to apply downstream. You need to set up all your subcontracts. They should have a contract summary with key terms and conditions, key dates. You should have a folder structure per subcontractor. You should have key registers for every subcontractor, such as a variation register, their progress claims, their RFIs, interface issues, their quality and work, and some sort of regular weekly meeting, reporting process, and way to track actions and close them out. This stuff is genuinely very simple. It's not rocket science, but you just want to do it before the construction work starts so you're not constantly chasing your tail. How difficult or easy it is to administer the contract during execution is going to directly relate to how much time, effort, and quality of the project setup. Contract administration during project execution is fundamentally just doing what we said we were going to do. Again, it relies on us executing the project correctly, our construction management. But if we've set up the project correctly, contract administration during execution should be relatively easy. So, contract administration during execution is simply delivering the project as planned. The systems are set up. Execution is about following the processes we've established. We want to deliver the agreed upon scope, get paid on time, protect our time and margin, and create records that support our entitlements. There's really 2 sets of processes we're following. Business as usual tasks, so delivering the project as planned, repetitive, structured, and predictable tasks, weekly meetings, monthly payment claims, and then change and issue management. So when change comes up, how do we manage deviations from the plan? How do we ensure we get our variations on time or get EOTs if we're entitled to them? So if we're talking about business as usual contract administration, the first thing I want to say is, as we all know, delivering a construction project involves a significant amount of communication. First thing you can do during the execution of the project, you just have to have a commercial lens when thinking about all this communication. That's basically ensuring that your communication follows the correct channels, involves the correct recipients, and is in the correct format. The general principles I would talk about is you want to document everything. If a client verbally tells you to do extra work, I mean, this isn't rocket science, this is very common sense. You just want to make sure that you get it in writing. If someone tells you to assume something, again, you need to make sure you get it in writing. General principle is document and record everything. So that means meeting minutes, distributing meeting minutes, making sure that the client project manager is copied in on it, that the relevant people are aware of directions you've been giving. You've been told to make an assumption, you've been told to do something. You just have to get everything in writing. You have to document it and categorize it. Now, the next thing I want to talk about as a business as usual activity is maintaining the construction program. The construction program is one of the most fundamental contract management tools. It's not just a planning and coordination tool. It's fundamentally a stakeholder management, so communicating progress to your client and being able to explain clearly when things change. Depending on the nature of the type of construction work you do, your overhead costs might be 20% of the contract value. Overhead costs are fundamentally driven by the duration of the project. So the project manager's salary, the temporary officers you have to hire, the security guard who's coming to check the fencing at night, that is all driven by the duration of the project. So if you can clearly articulate and show a program with your sequence of works and what milestones you're relying on by the client, if they do anything that delays you, it's going to make claiming an extension of time and mitigating your risk with liquidated damages, but getting paid extra for your overheads so much easier. So basically, a fundamental task is going to be maintaining your construction program, making sure it's simple and it makes sense, updating progress regularly, which again is going to help you to communicate your progress and get your payment claims approved faster, identify risks and issues early, and communicate any changes as part of your construction claims. So the structure of the program and how you maintain it is essential, but the way you track progress is also going to be absolutely essential. So this is basically having a system where you're regularly measuring how much work is getting done. So that's could be measuring linear meters of trenching, doing a weekly survey pickup for earthworks to get total volume. But basically you want everything to be measured, defensible, and evidence-based. So this could be evidence like photos, QA records, test results, delivery dockets for materials or survey data. Progress tracking is going to feed directly into your payment claims, your variation and delay claims, and substantiating everything. So we've got our communication, we're tracking progress, we're maintaining our program. The next business as usual task that's going to be happening every month are our payment claims. So payment claims are just a repeatable process. So they're the same format every month. You've set up our template correctly. So what we're doing is we're taking the data we've collected from measuring progress, we're compiling our supporting evidence, we're submitting our payment claim with so much evidence that the client can't push back on it, and it's factually accurate, and then we're basically invoicing and tracking payments. So typical process any payment claim will do. Say your payment claims are due by the 25th day of the month, you send it to the principal or superintendent if there's one, or your client. They review your claim based on the documents you've submitted and any substantiation. You agree on the claim, maybe you go back and forward a little bit. They will then issue a progress certificate and then you invoice for it. So that's why having a payment claim template like this set up at the start of the job with all your quantities, all your rates, showing that to your client, showing exactly how you plan to bill them is going to make life much easier. And then I've already touched on this, but again, meeting minutes every week, document everything, go through any registers and update your open actions, send them out after and get everyone to agree with them. That will definitely make your life easier later on in the project. Okay, so those are the business as usual tasks, the regular, ongoing, weekly, monthly things we're doing. What about when the project deviates from the plan? Well, first thing I want to say is change will happen. Change is inevitable on construction projects. There's really two reasons for this. We talk about the act of contracting work to another company, so subcontracting, or if you're a project developer, engaging a general contractor. Scope is complex, uncertain, and messy. It is very hard to define exactly what you want done. Inherent to this process is the fact that there are going to be deviations during construction. You're not going to define scope perfect. There is just always something that isn't considered during the tender phase that ensures that change is going to happen and there are going to be deviations from scope. The other reason is that construction itself is uncertain. There are things it's impossible to know during the tender phase that will come up during construction. So change is going to be inevitable. Contracts have processes to manage this formally through variations. So variations are fundamentally changes to scope time quality, the contract conditions, and there is some adjustment to the project costs, the project completion date, and the project scope as a result of this. There's fundamentally two types of variations we need to understand. There is a proposed variation, which means before the work is done, the client is requesting the contractor to do something different. Say they're building a building, and instead of having one lift shaft, they want two lift shafts. The original contract, the way it was drafted, the way it was written, it said one lift shaft on it. Everyone agrees there's a change. There's going to be two lift shafts. The other type of variation is a variation that is claimed by the contractor. So this is after the impact occurs. Say the project start date or the date the contractor is meant to get access to site is the 1st of May. The contractor actually gets access to site on the 14th of May. They make a claim. They say, hey, we've been delayed giving access to site. Here is our EOT claim. So that is a claimed variation. The difference between a proposed and a claimed variation is fundamentally a proposed variation, the client is going to agree to it before they propose it. So the only thing they can argue about is the cost of the change, or the cost and the time impact of the change. A claimed variation happens after the impact occurs. They both have to agree that yes, it was a change, yes, it was the client's fault, and then agree to a valuation of it. A variation proposed generally follows this principle. The principal will propose additional scope before the date of practical completion. The contractor will then advise whether the change is in fact feasible and the cost and schedule impacts. They then negotiate the cost and schedule impact. The principal may not decide to proceed with the change at all. They may decide to get another contractor to do it under a separate project, or they might get the contractor to do it. They'll negotiate this price, and if they agree to it, there'll be a change in the contract sum, the practical completion date, and the scope of works. The contractor would now be responsible for delivering the variation scope within their practical completion date. Principal may reject the change, in which case there's no change at all. The second type of variation is a variation that is claimed by the contractor. This process initiates when the contractor becomes aware of grounds for a change. The contractor will submit a notice of claim and details of the claim. Now, as I've already mentioned, this notice has to be submitted within a fixed period of time from when they become aware of the change. This is referred to as a time bar. If the contractor is delayed in getting access to site, they might have 5 days to notify the principal that this is going to be a variation. They can't do it 6 months later at the end of the project and say, oh no, you were late at giving us access to the project at the start. Now we want to claim that additional EOT. Can't claim things months after they happen. Fundamentally, the reason for that is it gives the principal, if the contractor has to notify the principal when they become aware of the grounds of claim, it gives the principal a chance to do something to fix it. And it also prevents these messy situations at the end of the job. So once that claim has been aware, the principal is really going to he's going to look at it from two angles. They're going to look at who caused the delay and if it is in fact the delay. If the contractor caused the delay, obviously there's no grounds for a claim, but it could also be a joint claim where both parties are responsible, in which case they determine what is the impact of the delay, both in terms of cost and time, so adjustment to the practical completion date. And then if they do agree, if it's a joint claim, if it's joint fault, maybe they negotiate something like they can change the practical completion date, but there's no adjustment to cost. If it's a principal caused delay, there will be adjustment to both time and cost. So again, in the business as usual section, this is why I was stressing about the importance of maintaining an accurate and realistic construction program, showing when everything is going to happen and what access you rely on from the client. Because if you have a really good program, it's a link to how you're tracking progress. You're clearly articulating how something's going to be built. It is going to be much easier to claim changes to project time, which means you can also claim indirect and overhead costs, and you can reduce your risk of liquidated damage. Now, claims aren't always delay claims. You can have an acceleration claim. So this would be where the client asks you to bring forward the practical completion date. Maybe they want you to finish faster. You can obviously have delay claims. If you have an impact to a non-critical path activity, you can have a disruption claim, which is where you don't adjust the practical completion date, but you would get extra costs because you can't do the work as efficiently. Or you can have neutral and joint delays where you negotiate some sort of change to the completion date, but maybe not cost. Again, a really good program like this that shows the critical path, the sequence of the works, and what you're relying on from the client is essential. You can look at this schedule and you can see, say for the clearing and grubbing, that the contractor was reliant on an environmental clearance permit from the client. You can clearly see if they are delayed in giving them that permit, that activity is on the critical path. If the clearing and grubbing takes a week longer, it'll push out the project completion date by a week. Now, if there are issues in the performance of the project, poor performance can occur on either side. Maybe the principal, for whatever reason, stops paying the contractor, or the contractor stops doing the work. The contract will have a process you follow for how you deal with this sort of default and what notices you have to give. Basically, again, it's going to come down to, it's always going to be much easier to manage the contract with a good relationship with the client, but it's just about clear records, timely notices, and responses that make sense. If you do end up in a dispute, again, the typical process will be negotiation, some sort of conference. Then you'll go to expert determination, where an expert's brought in to determine who's at fault. And the worst situation would be some sort of arbitration. Once we've finished delivering the project, the final stage of contract administration and delivering any project is closing it out. What does this actually mean? Well, it means you've completed all the physical works and this is an important and, you've fulfilled the contract obligations. The second part of this is an important point that people miss, because fundamentally, you can complete the project, but if you haven't done all the stuff the contract says you need to do to complete the project, you can't achieve practical completion. So I'll give you the long story short of how to effectively close out a contract. It's work out what you have to do from the contract to close it out, document all of that, and systematically go through it and make sure you've submitted every document, signed off every checklist, and fulfilled your obligations. So fundamentally, if I go into this in more detail, to prove the works are complete, you need to show that all the construction activities are fully complete, all the project scope, all your inspection and test plans are carried out, and all commissioning activities are completed if applicable. Then you need to go through a formal handover process. These will be joint walkthroughs with the client where they see what you've built. They have an opportunity to develop a defect and punch list, and these walkthroughs are documented and signed off. So basically, the client will get a chance to inspect your works. They'll identify a series of defects. That goes onto a punch list. You close off the items on the punch list, and that is the agreement between you and the client that the physical works are complete. There's fundamentally two important categories of defects. Defects that prevent the use of the asset and defects that don't prevent the use of the asset. If you're building a road and for whatever reason you haven't done the line marking, that is a major defect. You can't safely operate the road without the line marking. If you're missing a label on an electrical pit lid, that is a minor defect where you can still safely operate the road. You just put a temporary label on the pit lid. So defects that prevent the use of the asset need to be closed out before you achieve practical completion, because by definition, to have completed the construction project, the owner would have to be able to use whatever you built. Minor defects like the label on a pit lid, where you can put in a temporary label where it's not a big deal, these can be closed out after practical completion. You should close them out before practical completion, but practically say, I don't know, the pit lid labels are going to take a year to get fabricated. They won't take a year, but just for the purpose of this example, and you can't practically get them, you're doing everything you can, you would typically create a post-practical completion defect register of things that are minor and outstanding that you'll close out during the defect liability period. So the non-product closeout are fulfilling all the paperwork and other contract obligations around practical completion. So these are things like getting the as-built drawings, test certificates and compliance records, the certificate of occupancy, operations and maintenance manuals, warranties from suppliers, owner training, spare parts, maybe a register of all the keys and access logins. These will all be detailed in the contract, but these are all the paperwork side of closeout. And the way to manage these sorts of things is with a requirements register. The requirements register should be a document you create during the pre-construction phase. It's a register that details all the non-product requirements. So all the as-built drawings, product warranties, owner training, everything you have to do to close out the project that doesn't form part of the physical construction works. Projects that have done this have been so easy to close out. Projects that do not do this are an absolute nightmare, and you end up creating this register at the end of the job, so you're not actually planning for some of these requirements. Because the reality is drafting an operations and maintenance manual may take a couple of months. Getting spare parts can take 6 months for major bits of plant and equipment. So you need to understand at the very start of the project what your requirements to close out the project are and be systematically tracking them. So this is how I like to do my requirements registers. You have an activity or just deliverable, reference to the contract, a responsibility, someone's doing it, a due date, a status, and linked correspondence. So for example, if RFI 422, that is the item where you closed out the as-built drawing submission, that correspondence record is listed there. So it's a register that tracks every contract requirement with evidence that it's been closed out. Now, if you do this, submitting and getting practical completion will be unbelievably easy because you can attach this to your notice of practical completion and you can show that every requirement in the contract has been checked off. So once you've done all the work, once you've got a process for closing out defects, once you've closed out all the defects that prevent the use of the asset, your documentation requirements are satisfied, you can submit your notice for practical completion with all of the supporting evidence. The way most contracts are set up is once you get practical completion, your client approves it, 50% of your security will be returned, and then the defects liability period will begin. The defects liability period is a period of time after practical completion where, as the contractor, you have an obligation to fix defects, but you've also got the entitlement to fix them yourself. The client can't get in another contractor to come and fix a defect without notifying you and back charge it against your security. During the DLP, they aren't able to do that. They have to give you notice to fix it themselves, unless it's an urgent or safety critical defect. At the end of the DLP, once you have closed out all the minor defects, there's no other outstanding issues, you can then you can make a final payment claim and you can effectively fully close out the contract and get your security returned. So that's the basic process of closing out a construction contract. Again, this requirements register will change the way you manage project completions. It is one of the most important documents or just general activities to think about. So I hope that helps. I hope that gives you a framework for how to administer construction contracts and ensure your projects are more profitable. If you want a more holistic view of contract management, then watch this video next.